Happy New Year, welcome to 2020, and guess what? We got here without event. The Fed successfully squashed volatility in the repo market at the end of the year as we turn the corner into the new decade, and there was no spike in repo rates, there was no treasury sell-off, there was no stock market sell-off. The Fed did their job, they succeeded, it worked, and now it's smooth sailing with permanent highs, record highs day after day in the stock market for the foreseeable future, as far as we can tell. What do you mean that doesn't make any sense? Fed's balance sheet is $4.5 trillion. They just keep on printing money, the markets keep on going up. What could go wrong? Let's dive in. All right, guys, as you can clearly tell, we did not have any sort of a spike in the repo market, the overnight lending rates. The Fed successfully navigated that turn of the year. There was no treasury sell-off, no market sell-off, and there was pretty much no volatility. And so we entered this year with a bang here after this first trading day where the markets were up. Everything looks like it's smooth sailing. So what was the cost? How did the Fed do it? Why were so many people crying wolf? So many perma-bears out there saying that everything was going to come to an end. So many doomsdayers saying it can only go on so long. Well, as long as we disregard history, those people were clearly wrong, and it can go on forever because as we can see, the Fed just keeps on printing money and printing money and printing money. Obviously, they're not actually printing physical money for the most part. They're just typing in buttons, clicking money into existence, creating digits out of thin air, crediting accounts at the Fed, offering cash to the primary dealers who then go out into the repo market and lend that cash at favorable rates. They're fixing the prices of overnight cash and lending to make sure that all the hedge funds and other banks and financial institutions who don't have enough cash can get it at favorable rates. Because if you are a person with assets, but you are short on cash, you can just walk up to your local Fed office and say, hey, I've got a lot of assets, but I don't have any cash, so give me a couple $1,000s to make it through the next couple of days, couple of weeks, and I'll pay you maybe 1.5% interest, and then we'll call it even, right? Now, obviously, this is something that is only available to banks and financial institutions and hedge funds because they are the important ones. But it was likely because of this report that came out that Zoltan Pozsar wrote that made huge waves in the financial circles that made its way all the way to the Fed, and we know the Fed was aware of it because when the Federal Reserve Chairman Jerome Powell got asked about this specific report in the last Fed Open Market Committee conference meeting, they asked them about it and they asked what their plan was, and they really dodged a bullet there. They didn't really answer the question, but they were aware of the implications of the year-end cash crunch liquidity needs and what it could do. So what did it cost? Well, the Federal Reserve injected about $255 billion into the repo market system to make sure that there was absolutely no volatility. They squashed any cash crunch liquidity needs there would be, made sure that there was absolutely plenty because they offered up to $490 billion and only about $255 billion was actually used. And on the actual night of December 31st, there was just a little over $25 billion that was provided specifically for the overnight funding, and a few billion more than that was offered in the 14-day repo. And so the Fed was on the ball with this, printing money as fast as they could to make sure that there would be absolutely no volatility going through the year end. Now, all of this has led investors and economists to wonder what next. If the repo market is hooked on these massive injections of liquidity in order to quell any sort of volatility and keep rates at the levels that the Federal Reserve wants them, how is the Federal Reserve ever going to back out of this? Because if the Federal Reserve needs to do this right now, and initially when the rates first spiked, it was 1 day, then it was 3 days, then it was a couple weeks, then it was until sometime in the end of this month, January. It's yet to be seen when they'll actually back out of this and start reducing the amount of liquidity that they are providing into this market. So the question is, what did it cost? What are the implications? What are the ramifications and the consequences of this? Because clearly there's no volatility, there's no sell-off, there's no treasury sell-off, there is no market fluctuations. We had a smooth record-setting end of the year, and now it looks like at the start of 2020, we're off to a pace that if it continues, the S&P 500 will see a 153% return this year. And really the answer is we don't know yet. We'll see. There's always consequences to doing these types of massive liquidity injections into markets and economies. It took a couple of years for the Federal Reserve to wind down its balance sheet from the $4.5 trillion down to the bottom before they reversed courses on the interest rate hikes. They paused and then they started lowering again, expanding and exploding their balance sheet yet again to where it's only taken just a couple of months to get right back where they were before they started letting their balance sheet bleed off. So the size of the balance sheet expansion and the accelerating pace that we're seeing it take off at like you've heard before, is at levels that you normally see during panic, emergency, crisis modes, not at times when the market is at all-time highs and volatility is squashed into pretty much non-existence. So we'll just have to wait and see the next place that it leaks springs in the financial system, because yes, they've kept a lid down on the rates of the repo market, but there's pressure building in the system, and so it's going to break out one way or another. It's just yet to be determined and yet to be seen how it will play out. So as of right now, all of the additional money that is being created, the monetary expansion, is resulting in isolated inflation right now in terms of asset price inflation. We're seeing the housing market go up, the stock market go up, and then in certain specific select areas of the economy like healthcare and education, and we're starting to see it break out in things like food. So stay vigilant, keep an eye out. I'll update you as soon as there is any news to update you on in terms of how this is going to play out. Obviously, I will let you know. Thank you so much for watching. You have a great day.